Call the roll, please.
Senator McDaniel. Senator Mills.
I'm here in person.
Senator Neal. Senator Parrott. Senator Wilson.
Here in the room.
Representative Graham. Representative Petrie.
Present remotely from House District 16.
Thank you. Representative Tipton.
Present in the room.
Representative Weber.
Present remotely from House District 26.
Thank you. Representative Wheatley.
Here in the room.
Joseph Fons. Mike Harmon.
Is Sarah Beth Gregory attending as proxy for Auditor Harmon?
John Hicks.
Here.
Thank you. Sharon Mattingly. Representative Miller.
Here in the room.
Senator Higdon.
Present in the room.
Representative Duplessis.
And I am here. Thank you, and we will get started. I will say, Sarah Beth Gregory, welcome. And of course, Auditor Harmon is a non-voting member, but we do encourage you, if you have any questions, please let the chair know, and we'll happily hear those. So if we could, before we get started, we could vote on last week's minutes and have an approval of those minutes, please.
Motion.
From October 19th. Got a motion and a second. All approve?
Aye.
Like sign? All approve. So we do approve those minutes. So getting into that, we are going to start with Bo Craycraft. If you're ready, Bo. And he is the Executive Director of the Judicial Retirement System, but we'll let you introduce yourself, sir.
Mike. Sorry about that. Good afternoon. My name is Bo Craycraft. I'm the Executive Director of the Judicial Form Retirement System. Hope this finds everyone well and ready for the Thanksgiving holiday. It's good to be here with you all. Got a short update, a couple slides. To start, we were asked to provide return and cash flow information as of June 30, 2021. We actually included very similar information in our September 31 update, so I was not going to prepare. I did not prepare or plan to spend a ton of time on these slides, but I wanted to give those to you. Slide 2 is the plan's investment performance. Much like you all have heard in prior testimony from the KPPA staff and TRS staff, fiscal year 21 was a historic year on the investment front. You're going to see that reflected on the cash flow data and then also with regards to the actuarial evaluation. Moving past the most recently completed fiscal year of 2021, the first quarter of 2022 was relatively flat. The S&P 500 was only up just under 0.5%. Actually had pretty decent returns in July and August, but September saw most of those gains taken back as inflationary concerns and concerns with future growth continued to kind of rise. With regards to the R2 plans, as of September 30th for the 3 months ending first quarter of the fiscal year, both plans slightly underperformed the plan benchmark. They were up about 20 to 25 basis points for that 3 month period. However, if you look over a 10-year, 14.5%, and it was 9.3% for the 28 plus years since inception. So that's just to give you a little update post June 30. Slide 2 or 3 is the cash flow information for fiscal year end as compared to the prior 12-month period ending June 30 of 2020. For the most part, cash flow was pretty consistent. You can see that the net cash flow before asset gain losses, which is that gray shaded line, negative cash flow actually increased a little bit year over year, but most of that is due to the fact that our request for employer contributions declined as a result of the 2019 valuation. So you can see in that second line item that contributions from 2020 to 2021 declined. That accounts for most of the negative cash flow increase, which is kind of expected for plans that have healthy funding levels. You're not going to ask for as much money today. And then, as we talked about, you can see just the unrealized, realized gain, asset gain losses from 2020, which was a fairly modest year, to 2021. Just with regards, JRP, just to point out, almost 150 million in asset gains, which really drove those plan assets up. Now, I know the primary subject was the valuation data, and we have that on slide 4. It's a snapshot of the funding valuations that were recently completed as of July 1, 2021. Just as a reminder, JFRS does not conduct annual funding valuations. We do those every other year in coordination with the budget biennium. We do roll forward GASB valuations in the even number years. So the most recent funding valuation was conducted as of 2019. This is July 1, 2021. We discussed a couple key changes that the board made during the September PPOB meeting, so I just wanted to reiterate those. Number one, new assumptions were adopted as a result of an experience study that was conducted in October of 2020. Though that experience study was approved in April of 2021, and those new assumptions were put into place for this valuation. Modest changes except for the mortality assumptions. That was the most material change. The other key change is that they also revised the return assumption for the cash balance tier of benefits. We talked about how that plan is aging out of its kind of initial 5-year period and upside sharing is occurring. And so that return has also been updated to the 6.5% return that is currently utilized on the legacy tier of benefits. Thirdly, they, from an actuarial standpoint, the 2 tier of benefits were also consolidated for actuarial purposes. In years prior, they would run the actuarial evaluations completely separate for the 2 plans. Again, that was partially due to the kind of the runway that they were trying to create to get to 5 years for the cash balance plans. But with the 2021, they are now being consolidated. And so instead of seeing kind of 4 underlying reports, now you just see 2. One for the judicial retirement plan and one for the legislative retirement plan. That does include pension and health insurance. And when you look at the valuation, the assets are allocated across those two benefits. Looking at the slide on the right side, you can see a snapshot of plan membership as of July 1, 2021. We've also, within those groupings, identified those that are part of the legacy tier and the new cash balance tier. I did that really just to kind of point out, you can start to see specifically with the LRP plan, the active membership is over half cash balance now, which is a change from the 2019 valuation. That's a lot due to just the term limits are shorter with regards to legislators. On the judicial side, it's still heavy with the tier 1 or what I would call legacy members. A lot of our judges are 8+ year limits, so the turnover there is just not quite as high. We do have a fairly big election year coming up at the end of 2022. Every single one of our judges except 2 will be up for a re-election. So I expect to see this chart change as we go forward. But moving to the left side of the slide, this is the information that most folks are interested in. The funding statistics are on the top half. Contribution levels are on the bottom half. In both cases, across both plans, or all 4 plans, pension health for both J and L, you saw funding levels improve and you saw the requested employer contribution decline. As we mentioned earlier, a lot of this is due to the positive asset gains. We talked about the $150 million that was earned on the JRP side. Just as a reminder, with regards to the valuation, those asset gain and losses are smooth. So only about 20% or only 1/5 or 20% of those gains were actually realized in this current valuation. And so when you look at projections, you're going to see those asset gains continue to be recognized, which is going to help, again, push funding, assuming that all of our other assumptions continue to, we meet all of our current assumptions. As you can see, with regards to 3 of the 4 plans, with the exception of the JRP plan, they have reached the fully funded status. JRP is just under 95%, but again, the ADEC, or the actuarial determined employer contribution, did decline with regard to that plan from just over $7 million to just under $5 million. Now, I will note there's one oddity that you probably recognize pretty quickly on this slide, and that is with regards to the legislative retirement pension plan. It is fully funded, but there's still a projected ADEC, or an employer contribution. It's a bit of an oddity, and it's, when we provided our preliminary budget request, we preliminarily thought it was going to be 0. In my public comments, I said I thought it could potentially be slightly above that, and that's with regards to the way that our plan recognizes and amortizes any unfunded liability, or in this case, you have a surplus of actuarial assets. And it's a mathematical oddity, but as you can see on the bottom half of that slide, the recognition of the asset surplus the 1% and plus interest doesn't quite cover normal costs. So there's a very small, a request of $27,000, which, I'll fully admit feels, kind of weird to ask for $27,000. But that's due to just the way that we're mandated to allocate or amortize our surplus of assets. And it's something that we want to try to address. I know today I was asked to discuss some housekeeping requests. I know that's the second item on the agenda, so I don't know if you all want me to.
We're going to let you go ahead and do
Okay.
that. Before you do, I think we'd like to open the floor to see if anybody has any questions about your numbers.
Absolutely.
Representative Tipton.
Thank you, Mr. Chairman. Bo, appreciate you being here.
Mm-hmm.
And I know we've had this conversation in the past. Last 2 or 3 budget cycles, the General Assembly has chosen not to put the additional funding in the legislative retirement plan. But based on these numbers, is it accurate to say that has not negatively impacted the situation with that plan?
I think that's accurate. And a lot of that is due, to the outsized investment returns.
Sure.
In a normal world, I didn't expect us to earn 15% a year for the last 5 years, which is double the actuarial assumed rate of return. But yes, the funding level has continued to grow, and as you can see now, the funding request is effectively 0.
Yeah.
And unless something changes with regards to investment return or benefits, I hope not to see that increase.
Okay. Thank you.
And I do have one question for you, Bo. The percent funding for the health plans at 272 and 362%. You mentioned that there's some reductions in the requested amounts. Does that include health, or is that just pension?
So when you look at this slide that's currently up, there's a request for pension and health. When you look at that ADEC line, both the health funds have a 0 request. And that's as a result, of course, because of the current funding level.
Let me ask my question better. Should the employees who are paying into that fund be paying less?
That's an interesting question. And actually, during our evaluation, the presentation at our most recent board meeting, Finley, who is our third-party actuary, they actually made an interesting note and this is more specific to the hybrid. But with regards to the hybrid members in both of our plans, the normal cost is like 88 basis points, and they're paying in 1%. So it effectively has a built-in overfunded component to it. So to answer your question, they would say at a minimum there should be 0.88 being contributed to the hybrid cash balance insurance versus the 1% that those members are paying. Now, with regards to our plan, prior to the cash balance, all of our judges and legislators paid 5% up until 2008. The increase did go to 6% for 2008, but that was still appropriated audit to pension. So the only folks in our particular plan that are impacted by that 1% health insurance component is just the tier that is post 2014. So what we would call cash balance.
Okay. So in your recommendations, housekeeping requests that you're getting ready to go over, I don't believe you addressed that overpayment. It might be something I think you guys should consider to add. I'm not saying you should, but I think that should be talked about. It's quite overfunded, and that's coming from the taxpayer themselves. So
no, I appreciate that. When I actually initiated the housekeeping bill, that I didn't know that information yet. That was during our October board meeting. But it's an active discussion that was held at the board meeting, and so I don't, again, that 1% is being paid by the member. I don't think any member would complain if we reduced, the amount being withheld from their payroll.
Fair enough. Okay, continue on, please.
The last slide is just speaking to housekeeping. We have 3 primary housekeeping items that we would like to request. One of which is the amortization policy, and we touched on that. This is not a new topic. This is something that my predecessor, Donna Early, was working on prior to her passing. Quite frankly, our current statutes have a fairly dated model. It's a 1% of the current surplus or unfunded amount plus interest for that given year. So we're effectively only capturing or recognizing 1/100th of any surplus or deficit. In a normal model without excessive asset gains, a plan that had any unfunded liability would have trouble actually paying this off. We're a unique situation where 40% returns, 15% returns over a decade help you overcome that. But at the end of the day, when you look at actuarial standards and recommended practices, and I know you all have studied this on several different occasions, the model that we currently utilize is not really seen anywhere else. So we would like to move to an approach that's very similar to what the KPPA plans are utilizing in TRS. It's a base approach, and it would include layers in the event a plan fell below 100% funded. And so it would be closed if you had a base of 20 years. And then in our case, if the plans are above 100%, you can recognize kind of a larger percent of that excess, and you would not have a situation like you have with the LRP plans where you're still asking for money when you have a surplus of $6.5 million in assets projected. That's the only aspect of the housekeeping bill that would have an actuarial impact. We, of course, would have it reviewed by Finley, our third-party actuary. But our expectation is there would be probably a modest increase on the JRP side because it does have an unfunded liability, and we would be amortizing a slightly larger percent of that than 1%. On the LRP side, it probably would result in a zero ask, which is probably more reflective given its funding status. The second item is with regards to administrative expenses. This is something that the plan we're currently operating. We've changed the way that we're handling administrative expenses. This was something that was initiated prior to my arrival. In the past, JFRS had asked for a general appropriation above and beyond the ARC for the purposes of administrative expenses. A couple of years ago, that was kind of revisited with current language that's on the statute and also in the budget bill. And so the plan has started to build administrative expenses into the valuation process. This is consistent with how the other plans operate. And so the administrative expenses are being paid out of the trust on a pro rata basis based on membership. We would like to just add some language that clarifies how we actually request that money. We're effectively requesting access, or we're requesting authority to spend trust dollars. But given the fiduciary nature of our trustees, they just would like to have the clarity that, hey, we're going to request this. This is how the process is going to operate. And again, it's consistent with how we're doing business, so it would align statute with what we're doing. We've actually using language I think is very similar to the KERS KPPA language. So it would be consistent with what you all have seen in KRS 61. And then the last item is just some additional cleanup with regards to KRS Chapter 6 and 21. We have a few sections that still have some language that has since been voided. It creates some confusion, especially with members, but also just internally. JFRS has fully turned over their staff in the last 18 months. And so there's some newbies that don't quite remember all the old statutes. And so we would just like to do some cleanup to revise and just have the current statute reflect what's current law. And so those are the three primary items. We're totally open to the information you discussed with regards to the health insurance.
Possibly improving it.
Yeah.
Maybe a higher benefit. Either way.
Absolutely. We would be open to those discussions for sure. So with that, those are really the key items. We would love for the PPOB to consider this as a recommendation that they adopt in their annual report. We're very thankful that I've been able to initiate a conversation with Co-Chair Higdon, and we're working on a bill draft that we hope that we can share at some point. And again, we would have that scored by our actuary for sure, although we don't expect there to be a material impact for either of our plans. But with that, I'm open to any questions and appreciate the time and hope everyone has a great holiday.
I think you did good. Everybody understands. So thank you so much, Bo. Next on the list is Dave Eager, KPPA.
Which one you start with? You want to start with the actuarial? This one.
Thank you so much, Bo. Next on.
Do you want cash flow or do you want?
He wants the actual.
Yeah, but he said he wanted this to be up and ready.
You want the cake?
Well, I'll just put it behind it. Okay. You do it.
Yeah, I'll do that. Let's make it full screen for you.
All three?
Doesn't work that way. You're gonna have to close it out like they did.
Okay.
Welcome, Mr. Eager, if you would.
Thank you.
Announce yourself for the record.
You bet. My name is David Eager. I'm the Executive Director of the Kentucky Public Pensions Authority. And I have asked Danny White and Janie Shaw from GRS to be available. And if they are on, if they would identify themselves, please.
You're all alone.
Hi, Janie Shaw from GRS.
Danny White from GRS as well.
So I would, with your permission, I'd like to take the liberty to treat them as if they were at the table. And by that, I mean, if there's something they want to chime in on, they could feel free to do so.
Absolutely.
I don't know that it'll happen, and I don't know that there'll be questions that they need, but I'm envious of Bo. I wish we had those returns, but we had great returns. We had record returns. Fiscal 21, the overall return for all the assets in KPPA was 25.1%. It ranged from 22.6 in the K non-HAS to 25.6 in the C non-HAS, so it was a great year. I warned in an earlier meeting, if you look at a 25% return and a 5 or 6% assumption, we got 19 to 20% over the assumption. We've had a year in the past where we had 27% below the assumption. So there's two tails on this. We were fortunate to be on the proper tail this time, and and other things have allowed some pretty favorable trends. We have 10 out of 10 pension and insurance plans having contribution reductions. We had 10 out of 10 insurance and retirement plans having increased funded status. So we're 20 for 20. And that year, the 25% year, went a long way toward making that happen. But I also reflect back on the fact that I call it the 1, 2, 3, 4 step, and I give the legislature a lot of credit for this. 2014, Senate Bill 2 created the full funding, requiring the ARC to be paid. It also set up Tier 3. 2017, our board approved assumptions that made funding levels rise rapidly, steeply. K-9 has went up 70%, and we got the money to do that. And then in the 2021 General Assembly, we got House Bill 8 passed, which was critical. I've repeated this so many times. I say it in my sleep. And you'll see the benefit from that as we go through these numbers. So I thank you. I want to remind you of the cycle. The actuaries are using June 30th, 2021 data. So we're starting with fiscal 2021, if you will. We're presenting to you in November. The GRS provided that valuation to us at the last day of October. You're getting it in November per statutes. Our boards have already reviewed them in November, and they'll vote on them in December. And they'll take effect, the new rates will take effect July 1 of 2022. So it'll be fiscal, for the K, it'll be fiscal 23 and 24. For the C, it'll be fiscal 23. So it's kind of a funny cycle, but that's the way it works. I encourage any of you to call me with any questions you have. We're going to get into some complicated things, and we're going to get into some handouts where I can't cover everything. My number is 502-696-8444, and please call me if you have questions as a follow-up. So let's start with the good news. 20 to 21 to 25% returns. The 21 was the state, the 25 is the K, is the C9 has, and essentially all the insurance plans. So we beat our 5.25 rate for K9 has and state police pensions, and we beat 6.25 for the other eight plans. We got 902 million more than we expected. So if you said, all right, 5.25 to 6.25, what are we going to earn? We earned that plus another $902 million. And 556 of it's for the pension, and I'm talking about K9 has now. 556 of it's for the pension and 336 for the insurance. As you know, we take 20% of that each year for the next 5 years. So we'll only see the impact of 20% of that. We'll see the impact of the other 80% over the next 4 years. And it's layered. So we actually have 5 experience tranches, if you will, right now. This is a big one, the most recent one. And there are much, much smaller ones that will go off over time. But so we're not quite gaining 20% of 902 million, but we're gaining almost that when you layer all 5 layers in. This is a GRS comment, and I would echo it. It's imperative that we need to maintain or increase the contribution effort for K9 has. It's actually, it's just over $3 billion in assets now. I remember when it was 1.9, and I remember we were paying out $1 billion in distributions and benefits, and people were saying, well, you're going to go broke in 2 years. Well, we're not going to go broke in 2 years because we're getting contributions, and we're getting greater contributions. But nonetheless, we're paying out $1 billion on a $3 billion fund. Contribution rate for 2023 is going to be 1.129 million. So we will be expected to be in positive cash flow by about $100 million. Here's the problem that we've had that we've solved, largely, not entirely, but the declining active membership count in the K9 has plan in fiscal 21, it was down 4.8%. Over the last 10 years, it's averaged 4.3, so it didn't let up yet. But it didn't have the impact. It's not going to have the impact on us that it would have had in the past.
Sorry to interrupt you. Won't House Bill 8 dramatically affect that number or not?
Will it affect the 30,000?
No, the membership count, yeah.
Well, it's to be seen, I think. There's no longer a big incentive to lay people off or outsource.
Well, there's more than that. There's an incentive to bring them back.
Yeah. If you can reduce the cost of the employee by putting them on the payroll versus putting them in the
well, I think you had a requirement to bring
60%, 80%.
60, 80,
yeah,
then 100.
Right.
Or
I'm glad you reminded me. There is an incentive. I guess it can't be anything more than an incentive, but to get the workforce up to 60% on payroll for the next 2 years and then up to 80%, and the penalty for that is you'll lose those agencies that get subsidies from the state will not get the subsidies. So they don't have to get there, but they're strongly incented to do that. Yeah, thank you for reminding me. And again, there's not a disincentive to hire. It'll be normal cost only, which is up a little less than 10% now. That big liability is frozen. So here are the new contribution rates. Let me walk across to pension and insurance both add up to previously 10.10. I think that's stuck in a lot of people's minds. The 2021 val says it's going to be 9.97, down modestly. And across the board, they're coming down, 33 to 31, 146 to 140. We don't calculate a rate for K-9 housing the longer we calculate a dollar amount. And so the amortization of the pension is going to go from 920 million down to 906, and the insurance is going to go from 103 down to 88. The total cost is going to decline there from $1,023,000,023 to 994. So we're seeing the first positive effects of House Bill 8. Again, I got to refresh my mind between the prior slide and this, but essentially we're going from $1,163,000,000 to $1,129,000,000 in K-9 has, and small declines in both K-has and state police. So rates. We've pretty well hit the rates. Let me drop to the bottom of this page. The liability going from 2020 to 2021, K-9 has declines from 16,349 to 16,321. The actual asset value has risen, so we're going from an unfunded liability of 14,026 to 13,585. We're going from 14.2% to 16.8%. And I repeat this all the time. This is like paying off a mortgage. Each year early on, biggest part goes to the interest, smallest part goes to the principal, but it begins to get larger each and every year. You may have seen a number of 18.5 in the media. That's the GASB number. GASB looks at market value. It doesn't phase in gains and losses like the actuaries do. So if you look at the purely on a market value basis, we're at 18.5. State police, cost goes from 127 to 126 on pensions, on insurance 18 down to 14. The total cost goes from 757, or the unfunded goes from 757 to 730. So we've gone from 28.1 to 30.7. It's still a plan with extreme funding issues. I haven't mentioned, but the insurance plans, let me back up. Insurance, K-9 has it's up to 50%, but the hazardous is 60 point. I'm sorry, the hazardous is 135.5. It's overfunded. And again, state police is 82. The C plans are all now comfortably into the 80s. Here's the outlook. What you see is on the upper left, the decline in the unfunded liability gradually and then accelerating as we get closer and closer to what I'd call the maturity, year 2049, and we're working toward a 100% funded position in 2049. That is contingent upon meeting the assumptions. If we have a crater in assets in the final few years, or we have other things that we're off track relative to the assumptions, we may be above or below that number, but that's the target if we get all the assumptions. And you can see down below the contributions continue about flat for the next 28 years, and then the unfunded, the amortization cost goes to zero in 2049. The normal cost graduates down again. It's 9.9%. It'll graduate down to something below 5% in the year 2049. So the discussion has happened in the past, and we're happy to have it sometime in the future. about do you at some point in time, do you start to do what's called the glide path, and that is begin to reduce the amortization cost before 2049, but carry it out longer than 2049. But we're a long way from being in a funded position where we can do that, quite a long ways. In your packet, you have two things. You have the GRS sensitivity write-up, and rather than go into it in its entirety, I'm going to look at page 4 and 5, and again, you're welcome to, at your leisure, go through the rest, and if you've got questions, call me. But one of the things that's happened now is that the sensitivity to interest rates is de minimis. It doesn't matter much because we've locked in on that unfunded liability. So this is non-HAS. This is looking at changing the discount rate from 5 1/4 to 4 1/4, or up to 6 1/4 for retirement, and down one from 6 1/4 to 5 1/4 for insurance and the C plans and K-HAS. And I'll call your attention to, if you go down under the retirement, 4 lines down, funded ratio, there's the impact on the funded ratio if the discount rate is above or below what our expectation is. So it would be, it no longer be 16.8, it'd be 14.9 if we earn 100 basis points less. It'd be 18.7 if we earn 100 basis points more. The normal cost goes up to 11.3 or goes down to 5.4. That's for pensions. Insurance has a similar impact. But payroll growth now is a very de minimis effect, and it affects the normal costs and nothing else. This is changes in the inflation rate. The inflation rate also drives the discount rate, and it drives the payroll growth to some extent. And again, the impacts are relatively modest. If you wanted to extrapolate, you could take, if you went back to the 1% interest assumption and you wanted to make it 2 or 3, you can essentially double or triple the impact of that. Okay? Okay. Jennifer, I'm going to need your help. I don't see a minimizer here.
You don't want to do county employees?
Yeah.
You don't want to do county employees? You don't want to do, you want to get out of this?
Oh, I'm sorry, yeah. Well, let me ask, Chairman, do you want to see the county information, actuarial information? Okay, I'm sorry, Jennifer. That's why. 25% return, assumed rate 6 1/4. They produce an additional $2.5 billion in assets over and above the assumed rate. Almost $1.8 billion in pensions and over $700 million in insurance. They recognized a gain of $511 million, and they're going to recognize essentially $2 billion more over the next 4 years. Here are the contribution rates and the funded ratio. So we have in the C non-HAS, contribution rates coming down modestly from 23.88. I'm about the sixth line down, bolded, 23.88 to 23.40. Insurance is 4.17 to 3.39. The hazardous system, again, modest declines from 43 to 42 and from 8 to 6 plus in the insurance. Funded ratios in all the plans going up. Down at the bottom row, the C non-HAS is now over 50% at 51.8. The insurance is 85.4. I've commented on this frequently, but nationally, if you look at the numbers of 85% in the K non-HAS insurance and 84% in the hazardous insurance, those are almost off the chart. We are in really great shape with a fair amount of money compared to other systems. It's the pensions that continue to be the problem. So lastly, I didn't mention has pensions, but it goes from 45 to 46. Cost in aggregate, the contribution goes down from 733 to 691, and the C goes from 301 to 293. So they're going to get relief. The employers are going to get relief, and we're now out of the phase-in. The phase-in is done. We have no more phase-in. So the phase-in is still a slight negative on the cash flow situation, but it will be over in fiscal 22. Now I think I need Jennifer, because there's no... Jennifer?
Try hitting your escape button.
Yeah. But I need to minimize. Okay, I'll get it.
You just go down to here.
Yeah. And I'm not sure.
Next one.
Is that the right one? No, that's not the right one. Okay. Bingo.
So just go up here. No, this little one here. This little one over. Here, right here.
You're going to have to come back. Okay. June 30 results. Record year, I mentioned that. Ranged from 21.7 to 25.7. All 10 plans exceeded their benchmark. So we create a benchmark for a plan which says, all right, if we invested in the target asset allocation, for example, 18.75 in U.S. equities, and we earned the index, what would we have earned? And then we say, what did we really earn? And the difference is done if we overweight or underweight a particular asset category. Was that a good decision? Did it add money? And if we select the proper securities of the managers that would beat the index, did that happen, or did they underperform? When you aggregate it, we added something over 1% to the return, about to the assets, about $200 million in value added. It won't always be that way. There are going to be times when we're out of doing things that are out of favor, but we added about $200 million. Net cash flow for the total KRS plan, all the plans, was positive. If you add up all the plans, positive cash flow, and it was only $24 million negative for the total of the CERS. So that'll be gone. That should be gone next year, when the phase-in is complete. Returns were laid out by all 5 plans. This is a fiscal year to date is a June 30 year. We're talking about a whole year, so the fiscal year and the 1 year are the same. Assets are in the left column, but I say I'm envious of Bo's ability to earn returns comfortably in the 30%. If you saw us earning returns last year in the 30%, you ought to be concerned. We'd be taking a lot more risk than these plans are able to take. But 3, 5, 10-year numbers, or the lowest of the cumulative is a 20-year number, which includes 2009 and 2000, that period of time. But even there, we got 6.5%. But the key is looking forward, and we continue to see forecasts of investment returns, particularly after fiscal 2021, that are not robust. The outlook going forward continues to be relatively modest by investment managers and consultants.
So I'll go ahead and stop you because I know that's what all of us are thinking. The 5.25 versus the worst at 6.5.
Yeah. Yeah.
It would sure make it easier on the budgeting if it was 6.5.
Yeah. Well, it'll be the more we get the funded status.
I know
it'll help. I mentioned the outlook has not changed much. In fact, after the fiscal 21, when people were earning, some endowments are earning 40 and 50%. The outlook is not any better. It's probably worse because we're starting at a higher point. So we every year we go out and GRS helps us gather outlooks for people, and they have varying time frames. We tend to rely most on a 10-year time frame, but we're not seeing people raise their expectations. And if anything, it's going the other way.
Yeah. While we stopped, if Co-Chair Higdon would like to.
Well, Mr. Chairman, I think you pretty much asked what I was going to talk about, changing the assumed rate of return as of course, you don't want to do a knee-jerk reaction when we have one good year to change it, but and I guess what most people would, I don't know if they fully understand it, that the lower the assumed rate of return, the higher our contribution is. So if you raise that contribution back up, it would the General Assembly would make a lower contribution. Right now, at the tender moment we're in, and with our K non-has, is that we probably need to continue to make that contribution. We're pretty much a pay-as-you-go plan right now. We are putting in more than we're paying out, and that's a good thing.
Yeah.
It kind of gives us a practice if we ever had to go there. We're already doing it. That's not a thought I want to have, but that's I think those contributions are that where we're at is good. And if we'd always been where we're at now, we'd always putting in more than we needed, we probably wouldn't be having these conversations. Might not even have a PPOB committee because things would be good, and we wouldn't be sitting here with trying to figure out long term how to help those folks that are not getting a COLA from year to year. We are in a much better place than we've been. We're not in a good place, but we're much better than where we have been.
Yeah. Representative Duplessis, if you look at the sensitivity analysis, if we went from 5 1/4 to 6 1/4 pensions in the non-has, K9 has, the normal cost would go down from $782 to $541. That's roughly $25 million. That cost would go down by about $25 million. That's the impact of that. That's not that's a reasonable amount of money, but in the scheme of $23 billion, it's not a lot in terms of the assets. But we're constantly looking at it. I'll tell you, I think the fly in the ointment is inflation. What's going to happen with inflation? And we still have the two schools of thought. And I'm not, I have a bachelor's in economics, but I'm in no position to weigh in on what the inflation is going to be. But in the interim, inflation is going to be. If inflation rises, it's going to be detrimental. Bond prices are going to go down. It's probably bad for the market. Longer term, we'll have higher interest rates, and therefore we have more justification to have a higher assumption. But in the interim, it's going to be painful for the system. And I think we tend to think that inflation equals high interest rates, and that's good for returns. But to get there is not going to be good. Insurance, pretty much the same. We're mid-20s, and insurance is the 6 1/4 rate, and it's a portfolio that's a little more aggressive than the K. Cash flow, I said all the systems are positive except the C is still phasing in. Drop down to the the green line. That's contributions going in at $1,275,000,000 versus $1,083,000,000. That's a largely a result of a cessation payment that we received in excess of $170 million in pensions and something much less in insurance. We're paying out $1 billion in benefits, so we had a net contribution of $245 million, but that's been inflated by the cessation payment. But we're still, a year ago, we were 60. Without that, we were $60 million positive, kind of going across that line, road 2/3 of the way down. All C non-has has gone from a negative to positive. No, I'm sorry. It's gone from 16 to 16.5, and state police is 6.8 to 6.6. So they're stable. Then we add in investment returns, which are very volatile from year to year, and you can see we got $477 million in realized and unrealized gains versus $15 million. So that the key right now is pure cash flow is positive, and it's nicely positive. I mean, it's even without the infusion. C, on the other hand, hasn't gotten there. They're negative. Their net contributions are still negative, but they should be positive. I'm reasonably sure, and if not next year, the year after. Insurance, net positives, 106.5 million for K. Positive across the board. Again, big realized gains in fiscal 21 in all the plans. And in C, pretty much the same. Net contributions positive. Down 2/3 the way down. 140 million positive in the C non-hazardous, and 85 in the C hazardous. And that's that. I have September 30, but I could summarize that in about 2 seconds. Yeah. September 30, our returns were between 0.7% and about 1.5%, depending on the plan. So I think the good news there is, if we continue that for the year, we're going to come up a little short of the assumptions. But the good news is we haven't given anything back yet. I'm worried about the 25% being followed by a negative 10 or something. It hasn't happened yet, so we're positive. And that's the good news there. Questions?
I think we're silent. So
okay. Did
your numbers speak for themselves. Do I see any questions? Thank you. Oh, Representative Wheatley.
Thank you, Mr. Chairman, and thank you, Dave, again for the numbers. And there's a lot here. I think a lot of us up here have seen some numbers over the years that aren't that we don't smile or have. We have a lot more questions or concerns and frowns and furrowed brows and all that. A question I guess I have, it's really kind of a request, is to maybe look into. It seems like I've got on the NASRA site recently, National Association of State Retirement Administrators, I think, and this goes back to what Chair Duplessis was talking about related to increasing our amount from 5.25 to 6.25, and they issue regular reports, I believe, on the trends, or at least part of the report. We'll talk about trends in that investment return, and be interesting to see if that the trend has been to lower investment returns over time, and it has gone from 8 to 7.5. I think maybe even approaching 7.25 and 7%. So as those trends have gone that way, will they stabilize at something a little bit lower or not? And just maybe you can talk to us about that next time.
Yeah, I could comment briefly now if you want, and GRS probably could comment on it too. Yeah, I think the median is going to be below 7, and how much further it goes, but it's the mode is probably a little over 7. The mean is probably a little less than 7, but 7% has kind of gotten to be the number. But it's of the last 30 changes, 30 of them are going down. Nobody's going up. Nobody that I'm aware of. So.
Well, I'm hoping we're a trendsetter then.
Well, there's
at some point.
I tell you, I talked to a lot of the executive directors say, I wish we were where you are, because we'd be in a lot better shape if we had done that. But GRS, you want to comment anything?
I think a lot of the comments that I've made have been really good. I mean, there's no doubt that our investment return assumption is certainly below the median of the peers. But K-non-HAS is certainly a unique situation. I think a lot of the comments have been really good. The trend associated with investment return assumptions across the nation is definitely downward. And that is directly associated what Mr. Eager was saying about investment consultants. They're really just not projecting the same expected returns that they did 10 years ago. The trend about those expected returns continue to be lower year after year. Which is why we are, our recommendation has been to keep the assumption where it's at. We certainly look at that assumption each year. And then also looking at K-Non has and the cash flow, it's very important to continue to maintain our current contributions. We understand that the contributions are high, and budget-wise, it is hard, not just for the state, but also, the employers out there whose contributions changed dramatically under House Bill 8. But it is really important to maintain those so we keep both a positive cash flow and really to help maintain the increase in our funded ratio.
Thank you, Janie.
And I'd just like to throw in while we have the actuaries on the line. You had testified that, using a different valuation or some assumption would yield about $25 million, which isn't a whole lot of money in the scheme of things. But I think that only looks at your normal costs. It doesn't include your amortization costs.
Oh, yeah.
And so while we have the actuary on the line, could you, in my rough math, just doing it here on the paper that you provided me, is more like $110 million, not 25.
You are exactly right. I'm thinking pre-House Bill 8. Thanks for the correction.
Yeah. So if you could just, if the actuaries could just let us know what that, if we were to have an assumption change that was more in line with what we're seeing in a 20 or 10 or 30 year actual, what that would look like instead of the $25 million that was testified earlier for the normal cost. What would it be for everything?
No, I think I'm not incorrect. But if the normal cost goes down about 2.5%, and we're dealing with a $100 billion payroll, that's $25 million. GRS, you verify that?
You still have the amortization costs.
We still have the amortization costs.
Yes.
No, I'm saying the reduction in the normal cost would be by $25 million. Normal costs are going to go from.
I'm just asking if she could tell us what the state would see as a reduction if there was a change in that assumption.
So unfortunately, I don't have the executive branch numbers in front of me. But on a combined basis, the amortization cost would go from the 994 to about 1077 million. So that would be the reduction you're seeing. And I think our concern with the cash flow is, we're currently at benefit payments about 1 billion. And under the current assumption, our contributions, our required contributions are about 1.1 billion.
Yeah. Why don't we?
Danny, did you have another comment? I saw you jump on.
Yeah, I've got the exhibit up, and it's in your packet. The rate would go down. The amortization cost would go down from 994 million to be 921 million. That's from the system combined. Dave noted the change in the the normal cost rate. And I just reiterate what Janie said. This is, when you make an assumption change, you're now building in inherently more risk because there's no guarantee that you're going to get the 6.25 versus the 5.25. There's less probability for that. And then, in terms of the assumption process, the assumption making process, we've had many discussions with KPPA about this, and it's really driven by investment policy first. So that's where the assumption is kind of the driver or that's the first starting point. So it would really be, all right, what is the investment policy? And then let's find an appropriate return assumption based on that investment policy, not the other way around.
Yeah. Why don't we come back to you with a document? But you're right. The normal cost will go down 2.5. That's the 25 million. And that's for everybody. The unfunded liability goes from 13.6 billion to 11.9 billion, and the amortization that we'll have to make a calculation on that. That's the big one that needs to be worked out.
Yeah, and I understand where you're at. You want as big of a contribution as possible. You're in a 17% ish funded ratio. I get that, but it's the risk. I don't think that the assumptions should be based on the risk as much as assumptions should be you're assuming what actuals are going to be, not trying to avoid risk necessarily. I wouldn't think. Am I wrong to say that, Danny? Because I think that's what I heard you say.
I did mention the risk. Yeah, you're more likely. you're more likely to get the 5.25 than the 6.25 on a forward-looking basis. I mean, that's what happened this last year was just, I don't think anybody expected. I think if you were going to go in and go to anybody across the country, investment professional, actuary, or otherwise, say, model out what we would expect if we're going to get a pandemic. And I don't think this would be the outcome that would show up on anybody's notes or basis. So it's definitely welcomed. It's great. And the challenge is when you have 10-year treasuries at 1.5, 30-year treasuries below 3. That makes it hard to get those higher returns, and that's why the investment professionals keep lowering their expectations. It starts with bond yields. You're not all invested in bond yields, but that's kind of your starting point. You're trying to earn risk or risk premium on that when you invest in equities, real estate, private equity, other alternatives. So that's the forward-looking challenge that Mr. Eager noted about.
And I think it's duly noted, but I know as long as I've sat on this board, I've always heard that in the future doesn't look good, and that's why we're at 5.25. But every year, the future has proved to be very good. And I think I recall that it was said that just when the fund reaches $3 billion, we could then look at changing some of those assumptions. But we've hit that $3 billion, and we're still not considering that. It doesn't sound like. Yeah. So again, it's important that we fund you as you need to be funded. Don't hear me saying we shouldn't. But on the other hand, I don't want to super saturate the funding if we don't need to do that necessarily. I'd like that conversation to be held.
And that's a valid point. That is a point, and hopefully, with all the information, would show that we're not in that position. We're just you're net cash flow positive. You have $3 billion, but it's more than a $14 billion liability. The liability is closer to $19 billion.
Perhaps it would be helpful, and I'll stop here. But perhaps it would be helpful if this board and the General Assembly and state, for that matter, had a goal that we were working towards that said, if we got to X number of dollars, or we got to certain funded liability funded, we could do this and we could do that. But it feels a little bit like the goalposts get moved. Yeah. And so if we had something from you saying what those goalposts are and where they sit, I think that would be very helpful.
Right. In the C plans, we're funded in the mid-40s, and we were at 6.25. So that's the kind of thing you're thinking about. At some point, it's going to change.
Right.
It warrants change.
So with that, I will sit down and let Representative Miller speak up.
Personally, I don't think the goalposts are being moved. The goalpost in my mind has always been north of 80% funded, and we know we're near that. And so I would caution the body against overly optimistic actions. 22 years ago, I think this body did some things that it shouldn't have done, and we're paying the price for it now. So I would just say caution.
And again, duly noted, well said, and don't necessarily disagree, Representative Miller, at all. But I do think it's a conversation worth having that this body knows what the end game looks like, and what is it 80% funded that we actually back off and have an assumption rate that's more in line with what we're seeing, or is there some other number? But I think instead of us having our own opinions, there ought to be some things that are sent to this group that says this is when we can start being less aggressive with our 5.25 assumption rate. I think that's just the way it ought to be.
I'd make one last comment.
Yes, sir, absolutely.
GRS has said repeatedly, and we agree, these assumptions ought to be in little bites, not in big bites. And we waited so long to take a big bite, it hurt big time. And so if we do move on the upside, we'll probably I would suspect we'll be doing it in smaller increments and maybe faster than we would have otherwise. So.
Fair enough. Thank you. The floor is yours if you have anything else.
Did you want to speak to the housekeeping bill?
You can do that while you have the floor. Are you in line with what Representative Miller is going to be proposing?
Yeah, I don't know. Representative Miller, did you want to take the floor? I have Aaron.
Excuse me, Mr. Chair.
Yes, sir, go ahead.
No, their housekeeping bill doesn't have anything to do with the two bills that I've got.
And I don't think Aaron, I have Aaron Surratt, their Executive Director of Benefits, on the line. I don't know that there's a lot of what's going to happen in the housekeeping bill is just going to be cleanup from House Bill 9. And our staff member, legal staff member who's doing that is off on maternity leave. We'll be back shortly. Aaron, do you have any comment on housekeeping?
No, I don't have anything much additional. We had several significant bills passed last session: House Bill 8, House Bill 9, of course, the CERS separation, and Senate Bill 169, which was the enhanced benefits for the total and permanent in line of duty and certain duty related incidences. So those bills, bills of those magnitude, once we get in and start implementing everything, sometimes require some cleanup. So it's just general cleanup for most of those bills, and some other general cleanup that we're asking for, but nothing significant.
Okay, any other questions? Okay.
Thank you.
Yes, sir. All righty. Last and certainly not least, in fact, last and the largest would be the TRS. And Bo, if you would, come introduce yourself for the record. Thank you for coming.
Thank you. Good afternoon. Bo Barnes, Deputy Executive Secretary and General Counsel for the Teachers Retirement System. Bring my PowerPoint up here. Let's see. Here it is. There we go. Okay, there we go. Thank you again. I've been asked today to discuss investment returns for the fiscal year and most recent quarter end, cash flow update for the fiscal year and most recent quarter year end, the recent annual actuarial evaluation that's been completed by our actuaries for the fiscal year end June 30th, 2021, and also the budget request for the upcoming budget biennium. With that, we'll start with the investment performance. So this is for the Retirement Annuity Trust as of fiscal year end June 30th, 2021. I will focus on the bottom two rows. The very bottom corner next to the word net, you'll see 5.47%. That's the net return for the quarter, for that quarter ending June 30th. That has in the top 51% in the country compared to the large public pension plans. And I'll just keep on going. 29.59% for the year. And we're in the top 22%. 13.02% for the 3-year, top 7%. 12.91% for the 5-year, top 3%. 10.05% for the 10-year, top 4%. 7.35% for the 20-year. We don't have comparable data for the 20-year period. And then you'll see for the 30-year period that 8.59%. This is for the health. The chart shows the health insurance trust returns as of June 30th, fiscal year 2021. Same thing. I'll focus on the net. We don't have comparative data for the health insurance trust, but for the quarter, the returns were 6.25%, the 1-year 31.13%, 3-year 12.52%, 5-year 12.07%, and 10-year 8.22%. Same thing for the Retirement Annuity Trust, but this is for the most recent quarter end, September 30th, 2021. So just moving up 3 months from the previous slide. And again, the lower right-hand, left-hand corner, net for the quarter was negative 0.29%. Private equity outperformed public equity. And we have a lower exposure to private equity due to public equity, for this period, for all periods, but for this period, we saw private equity outperform public. We were in the top 84% for this quarter. It wasn't being in the top 84%, that's not really a function of any active investment strategies. It's just the way the markets played out for the quarter, favoring private equity over public equity and our lower exposure to private equity. For the 1 year, 21.32% return with that quarter end September 30th, top 58%. And I'll just keep on moving. 3 year, it's 11.8% return, top 12% in the nation. 5 year, 11.87%, top 7% in the nation. 10 year, 11.18%, top 7% in the nation. 20 year, 7.63%. And don't have comparative data, of course, and 30-year, 8.42%. And so, of course, all those time periods, those full-year time periods, not the quarter, of course, but those beat not only our most recent assumption, 7.1%, but also the older 7.5% return assumption. Moving next to health insurance trust, same thing for the quarter ended September 30th, 2021. The quarter returns was 0.62%. 1 year, 23.36%, 3 year, 11.54%, 5 year, 11.23%, and 10 year, 9.16%. So again, those returns beat the now 7.1% return assumption and even the 8% assumption that we had before. Cash flow. This is cash flow for the retirement annuity trust, and this is for the fiscal year end. And again, with these cash flow statements, you can divide this slide into 3 portions. The top third, cash inflow. The middle third, cash outflow. Bottom third, the results of the cash inflows and outflows and other things that are happening that I'll always point out. So we'll look at the top line, cash inflows. We see that member contributions from FY 2020, which is the column to the far right, increased from $324,700,000 slightly to $327,800,000. Employer contributions also increased from $1,134,300,000 to $1,147,000,000. Investment income dropped for that period from $370,800,000 to $257,600,000. Low interest rates are a large part of this. The investment income reflects just stock dividends and investment income. A large part of this is, bond interest, and bond interest has been low. So total cash inflows declined from $1,829,800,000 to $1,732,400,000. Next is cash outflows. We saw, and the biggest part of that always is going to be the benefits that we pay out to our retirees. And you can see increase from $2,195,700,000 to $2,260,600,000. Administrative expense, not really. It's a very small thing in the big scheme of things, but it increased from $12,200,000 to $12,600,000. So total cash outflows, $2,207,900,000 fiscal year 20, increasing to $2,273,200,000 in fiscal year 21. And just looking at the cash inflows and cash outflows from those 2 top thirds of the slide, you will see that cash flow increased from a negative $378,100,000 in 20 to a negative $540,800,000 in 21. I have a slide here in a moment that I will share that comes from our evaluation and will help put that in perspective, the negative cash flow in perspective. This is the really important line. The next one, the investment gains or losses, realized or unrealized. So that's increase in value of the assets of the system or sales of assets that we had, when they were valued high, and we could sell those and harvest those gains. So we had investment gains or losses of $723,200,000 in fiscal year 20. And of course, tremendous year for everybody in the markets. It increased to $5,759,300,000 in fiscal year 21. So a big change, and I'll just now the numbers in the center column. At the beginning of the fiscal year, going to the end of the fiscal year, we started out the year with $20,717,000,000 in retirement annuity trust, and wound up at the end of the period $25,935,800,000.
And let me stop you for a minute, Bo. Co-Chair Higdon has a comment.
And Bo, you probably know what it's going to be about the negative cash flow. And I know we, you know that you continually say that that's a healthy number, but I'm just always concerned about that number, and especially in a system we're close to 60% funded. But I know that's I just wanted to, I didn't want you to think I was asleep up here, and I didn't notice that. Okay.
So, Senator Hagan, I would never think that.
Okay. It is always a concern of mine. But anyway, thank you. And
hey, well, while we're stopped, if we could, Representative Miller would like to interject.
Along the same lines, and it's hard to pick anything bad out of reports like these, but it is curious. Why did the investment income net of asset gains and losses drop $100 million?
I think a lot of that is that's going to be fixed income bonds, and interest rates were just very low for that year. So I think that's a lot of what we're seeing with that particular line.
Just seems extraordinarily high. Third, basically. So, but if you get back to the office and you find anything else about that, let us know. Thank you.
But what would a system of TRS's size, a typical administrative expense be? Are you pretty well in line with other states, or what is a typical percent expense for a system your size?
We are actually much lower than other states. This PPOB did it was a Program Review and Investigations did a study, and the study's a little old. It was done in early, I think, 2012, 2013. And it looked at a couple years prior, to be fair, but it compared TRS administrative expenses and investment expenses with other pension plans across the nation. And there was a graph, and the administrative expenses were very low, extremely low. The median was here, and the TRS was the very bottom of the graph. So we're among the lowest in the nation, and that hasn't changed from when that study was done by Program Review Investigations Committee to today. We're still among the lowest cost system in the country, particularly for a plan that administers not just a pension but a medical insurance side as well.
Thank you.
We work hard to keep those costs down.
And does this show our investment costs, including any payouts to investors?
Well, the administrative expense is going to show, no, that's investment cost is outside of that. So let me check where that would be on this. It's not showing up on this side. You have some investment expense, I believe, in the administrative expense, but not all. Maybe all. Let me double check on that.
I would appreciate that.
I think for the purposes of this slide, which is a little different than somehow we report other things, because typically we're splitting out administrative expense and investment expense as two different expense items. That's proper accounting, but I think we combine it in this one. I think it's reflected in both in administrative expense.
Okay. Please confirm that.
But good year, over $5 billion gain in assets for the Retirement Annuity Trust. Health Insurance Trust, same format, and this is also for the fiscal year end. So cash inflows, member contributions were somewhat less, according to the slide, $192.8 to $187.6 million. Some of that could be timing, with this as contributions come in and are reported and audited and reconciled. Employer contributions up very slightly, $184.6 million. Versus last year versus $184.9 million this year. I think probably a little bit of a timing issue there perhaps as well. Maybe some COVID issues too over the year, possibly affecting some of these numbers. Recovery income, which is rebates and subsidies, rebates from pharmaceutical companies, subsidies from federal government that we collect. We saw those increase from $100.4 million in 2020 to $120.8 million in 2021. Investment income, same kind of story as we saw with the Retirement Annuity Trust, a decline from $13.2 million in 20 to $3.7 million in 21. Outflows in the middle section, the benefit payments, $305.6 million paid out in 20, $310.9 million paid out in 21. Slight decline in administrative expense here. This is just for health insurance, the health insurance portion of administrative expense. So a decline from $2 million to $1.7 million. And then total cash outflows, we see $307.6 million in fiscal year 20 versus a slight increase to $312,600,000 in 21. Cash flow is the next line. Cash flow improved to even a little better. $183.4 million in 20. It rose somewhat to $184.4 million in 21. And investment gains and losses, again, same story as on the previous slide, the Retirement Annuity Trust. $19.3 million for 20, and just great year. Almost $500 million in 21 at $499.5 million.
Well, I appreciate your speediness, but Representative Higdon, I was trying to look for a good place to stop, had a question.
Okay, yes, sir.
Bo, I couldn't help but notice on the health insurance trust fund, we have quite a significant positive cash flow there. On I guess we go back a slide, cash flow update on the health insurance.
This slide, or
yeah, that slide, yes, $184 million positive cash flow. I just want to make that comment. And
yes,
of course,
sir.
We hear from time to time about the legislator, the General Assembly, our contribution, that it's typically maybe more than what's actually needed. Can you comment on that? And it's, I guess, how it affects the cash flow.
Okay. So with shared responsibility, active members phased into paying additional 3% out of their paycheck towards the health insurance trust. Hadn't been doing that before. School districts matched that contribution, and other employers did the same thing. University rates were a little bit lower because their retirees retire later, like age 62, I think, on average. So they got a little bit less of a payment because we're paying health insurance less. And then for retired teachers under the age of 65 began paying towards the Kentucky Employees Health Plan premium amount equal to the Part B amount that is paid to Medicare for retirees 65 and over. And the Commonwealth agreed to pay the amount of the KEHP premium less what the retirees pay. So that's that Medicare Part B premium amount plus just whatever the cost of the plan is, like maybe $40 a month. So they're paying almost $200 a month, very roughly average, and the Commonwealth is paying about $500 a month towards that premium. With this structure in place, we're getting healthy contributions coming in. We've been extremely fortunate that health insurance costs, health insurance inflation has been much less than anticipated in 2010. We've been also very lucky that these federal subsidies, which pay most of the cost of our 65 and over health insurance costs, and those are really underappreciated what those federal subsidies do to help pay for those costs. They do pay for most of it, that those have remained in place since 2010. And I'll just name one, Medicare Advantage. That was something everybody thought it was going to last a few more years in 2010. We were going to Washington and talking to our congressional delegation and other people in the executive branch, but it stayed in place. So that health insurance trust has been a huge success story. It's grown much more quickly than anticipated. The budget did not provide funding from the state for the current fiscal year, for the health insurance. But you can see we are still growing. We are growing strongly, with the health insurance trust. The bottom line shows that, and it doesn't include the current fiscal year, but it's from fiscal year 20 to 21, we went from $1.616 billion in that health insurance trust to $2.3 billion. Tremendous. And we are going to continue to see that growth. And we anticipate that this health insurance trust fund, looking right now, and knock on wood, that medical insurance inflation and those federal subsidies don't change. We're looking at having this health insurance trust 100% funded, in a few short years, maybe as early as 2028. So, I mean, we're making great progress here. And that's something that everybody, all teachers, can feel really, really reassured about where we are with the health of the health insurance trust. So again, we had a gain in this health insurance trust fund from the beginning of the fiscal year to the end of the fiscal year of almost $700 million. And again, this was a pay-as-you-go benefit before 2010. There's hardly any money in here, just enough to pay a few months' worth of premium. So great, great news. These are the same slides for the retirement annuity trust and the pension. It's for the health insurance trust, except for just like before. This is for the quarter year, the period ending for the most recent quarter, September 30th, 2020. So again, same format, retirement annuity trust, member contributions. And again, I think this is a timing thing. There could possibly be a COVID thing as well, because we did see some decline in membership. I think largely because substitute teachers weren't in as much use during the COVID year as in prior years. We see a decline in member contributions from 74.9 million to 70.8 million. Employer contributions, we see an increase. Again, some of this I think really is timing. 271.6 million, 282.8 million between the 2 years. Investment income, same story as before, $69.4 million in 21, declined to $49.3 million in 2022. So total cash inflows, comparing those two periods, slight decline from $415.9 million in 2021 to $402.9 million most recently, for the most recent quarter ended period. Benefit payments went up slightly from $565.2 million to $583.8 million. Administrative expense, $3 million to $3.1 million for the quarter. Outflows, $568.2 million to $586.9 million. And then we see the cash flow, it's negative. It increased from $152.3 million for the quarter 21 from $152.3 million to $184 million in the most recent quarter ending September 30th. Investment gains or losses for the period. We had a gain in 21 of $1.265 billion. We had a loss, for this quarter, $137.3 million. So that's for the period ending June 30th. So, it's a quarter. It's a short period of time. I can tell you October was better. October, just on equity investments alone, we saw a 3% return. That doesn't include any of the private equity side. So if we have returns on the private equity side, it will be better than 3%. So, just one more month later, we're seeing, a change. So these short-term numbers are not maybe as helpful as the longer-term numbers, or they really aren't as helpful. So anyway, bottom line, lower left-hand corner, that middle column, the numbers, we saw that the assets at the beginning of the fiscal year for the Retirement Annuity Trust, and this is, again, just going through the most recent quarter, we had $25.935 billion at the start, $25.614 billion at the end of that quarter-ending period. Health Insurance Trust, same thing, quarter-end numbers. We saw member contributions decrease from $45.5 million in 21 for the quarter-end period, decreased to $43.4 million. Employer contributions, same thing. And again, I think some of this is timing and reporting, but $44.9 million to $32.4 million. Recovery income, again, that's rebates and subsidies, federal subsidies, increased from $21.6 million to $22.7 million. Investment income, same story. We had $2.3 million, 21, a negative $700,000 in 22. So total cash inflows, $114.3 million in 21, compared with $97.8 million in 22. Benefit payments refunds, $78.9 million in 21, $69.4 million in 22. and those are total cash outflows. Then we have net cash flow. We saw $35.4 million positive cash flow in 21, slight reduction at $28.4 million positive cash flow fiscal year to date for the quarter at $28.4 million. And then investment gains losses, $104.7 million in 21, $12.7 million in 22. Plan assets in the health insurance trust for the quarter ending period, $2.3 billion at the beginning of the fiscal year period, $2.341 billion at the end of that period. Okay, these are the actuarial evaluations. So every year, the TR's actuary performs evaluation. You know, they look at what they expected to happen, what happened, and I've got some slides that'll help explain that process a little more, what they do. But this is done every year by the actuary, and then as a result of the evaluations, that's when we get the report on changes in funded status, for example, changes in liabilities, changes in assets. So the top line here, the top box is the retirement annuity trust, and the bottom box is the health insurance trust. And I'm going to focus on the percentages at the right, but again, certainly happy to answer any questions about any of these numbers. But I do want to note before doing this that this annual valuation is the first valuation that's going to reflect the assumption changes from that recent 5-year experience study that we've talked about in past PPOB sessions. So this is the first time we're going to see the impact of lowering that assumed rate of return from 7.5% to 7.1% for the pension, from 8% to 7.1% for health insurance trust, and also those mortality tables, teacher-specific mortality tables and generational mortality tables where actuaries now assume that a 25-year-old is going to live longer than a 65-year-old. So that's a one-time thing. You're not going to see mortality tables change that much ever again because of what they did, but it made changes, and those changes were somewhat offset by the great return we had, the 29% return that I talked about, so they're somewhat offset, but because that return, that great return, is averaged in over 5 years, you don't see the full impact of that great year all at once. It's phased in over 5 years. So again, going to the far right column at the top, you can see that the funded ratio for the retirement annuity trust as of June 30th, 2020 was 58.4%. As of June 30th, 2021, as a result of that mix of assumption changes, the assumption changes, it declined to 57.2%, not quite as much as it could have, but for the great return year and using 1/5 of the value of that. Going to the bottom box, again, far right column, health insurance trust, you can see that's June 30th, 2020. That trust fund had a funded status of 61.7%, declined very slightly to 60%.
Bo, I'm going to stop you for a second. Senator Higdon has a question.
Yes, sir.
Thank you, Bo. I guess, that's really difficult. It's clear as mud when you look at this, how we have the best year, one of our best years ever, and then our funded ratio drops. And, of course, as you explained, that it's due to those assumptions. But, our unfunded, our liabilities, I guess they increased by $4 billion, and so I guess that was entirely due to the assumption changes.
Not entirely, but almost entirely. Okay, over $3 billion of that are the primary assumption changes that drive that, reducing the assumed rate of return and the mortality tables. The assumed rate of return is a little bit more impactful, but not much, than the mortality tables. Those were two big changes, and those are the primary drivers in the increase in liabilities. And you can see the assets did increase, not to reflect the $5.2 billion in additional market value increase we saw, but we were recognizing 1/5 of that market value increase essentially. So you see $20.8 billion to $22.6 billion.
And I only bring that up is to help, those who are watching understand how is that possible that we have increase in assets of $5 billion, but we still, our funded ratio decreased. And it also decreased in the health insurance fund by $700 million. So it's like I said, it's clear as mud sometimes when you're looking at this and scratching your head. How'd that happen?
If and it's a function of those two things. It's the smoothing, the 5-year smoothing of the investment returns and those assumption changes. If we use market value as opposed to the 5-year smoothing, the funded ratio for retirement annuity trusts would have declined slightly from 58.4 to 57.2. It would have increased significantly. We'd be up in the 60s.
Bo, if I, Mr. Chairman, one more comment. I don't know where smoothing came from, but I can remember back in those years where we had those huge losses. Smoothing came forward to make those losses not look as bad. I guess this is the opposite. When that doesn't make our huge gains look as good because we have the smoothing. So I don't know if smoothing is that good of a I guess accounting, I won't say gimmick, but a accounting procedure to use. But it does have its drawbacks.
It helps provide consistency in budget requests by smoothing the 5 years, and we have a great slide. It's I can't wait to develop, but I'm happy to show that. It shows actual market value, market returns. Okay, it's a chart, and they're going up, and then it shows the effect of the 5-year smoothing, and the market gains kind of go up and down like this. So June 30th, 2009 was not a realistic picture of what the markets were going to be long term. It was so negative. June 30th, 2021 is not a realistic picture of what the markets are going to be long term. But when we smooth those spikes, those peaks and valleys,
you get a trend.
And the 5-year smoothing, it's right in the middle of those, all the way over all those years. It follows right in the middle. So it's a very good method of trying to provide consistency in budgets that still follows the direction of the markets.
Mr. Chairman,
one more. Yes, sir. In fact, you can have as many as you want.
That might be the best explanation I've heard on smoothing. Thank you. I appreciate that.
Yes, sir. Okay, let's see. This was also in the actuarial evaluation, and just some highlights there. The top bullet point, TRS once again received 100% of the actuarially determined employer contribution, or ADEC, for the retirement annuity. Great news. It helps with our investments. It helps with negative cash flow. It is again, that's a sea change for TRS. When we started receiving the full ADEC, and we've been receiving now the very full ADEC, are very, very close, like 99 and 97% for fiscal year 17-18. But this is the 6th consecutive year, so game changer. Then the third bullet point there, this is to develop our actuary, and it's a measure of negative cash flow as percentage. So cash flow is negative at 3.79% compared to assets for 2021. And then you have the more recent years just below that. For 2020, negative cash flow of 3.68%, 2019, 3.48%, 2018, 3.63%. We were getting closer to, we were getting in danger of, we're over 5%, getting close to 6% very quickly. In 2016 and before, when we weren't getting the additional funding we're getting now. So that is having a huge impact on cash flow. And again, we're very, very thankful for that. The actuary also does this every valuation. This is a gains loss statement. And they look at what they thought was going to happen for the coming year and what actually happened and what they thought would happen based on the assumptions. And they perform this. And we've been doing this for many years now. But you'll see this is a snapshot. On the right-hand side, you're going to see gains, actuarial gains, okay? And on the left-hand side, actuarial losses. So 2 of those bars stand out immediately. The one at the top, we had a gain of $1,996,500,000 on investment returns, okay? Because we recognized 1/5 of that $5.2 billion that we had in returns. So great gain there. And then down at the bottom, you see, of course, those assumption changes that we talked about. And those assumption changes added $3,060 million in liabilities. So what the actuary does is it takes these gains or losses and then it amortizes the gain or loss over a 20-year period, which is it's called layering, in the actuarial world, and that's what they do. And we've been doing this for a while now, so that we capture every year, when assumptions or experience is different from assumptions. We capture that and we build that into our budget request.
So, Bo, are you using the same 5-year smoothing on the assumption changes that you are on the returns?
Yes, sir. Yes, sir. So it's no. I'm sorry. On the assumption changes, no, they are recognized immediately. So going from 7.5% to 7%, 7.1%, that's recognized immediately. And the mortality tables, teachers living longer, that's recognized immediately. What TRS is doing is the contribution requests that we are making on those changes and assumptions are not being recognized immediately. We are going to phase in those contribution budget requests over a 5-year period and kind of smooth in, that $5.2 billion gain that we got for 2021. But the assumption changes that are all here, that's that $3.06 billion. And again, mortality, what they did with mortality will never happen again. You'll never see a mortality change like that ever again. Budget request. And so this is for the upcoming budget. On the left-hand side, you see a description of what the budget request is for. Those middle two columns with numbers are what we actually received last fiscal year and the current fiscal year, so the last budgets, I'm not going to cover those because those are already set. But I will focus on the two columns to the immediate right, and those are the budget requests for the upcoming biennium. And I'll just focus on a few lines maybe for time, but the second row, that's health insurance funding. It's shaded in gray there. You'll see the requested amount for fiscal year 23 will be $71.2 million. For 24, it'll be $77.7 million for health insurance. Going on down below the box numbers, you'll see a line for amortized payments. You'll see something in the amount of $99.2 million for fiscal year 23 and $84.8 million for fiscal year 24. Those amortized payments, sometimes referred to as the green box dollars, those represent certain benefit adjustments that the Commonwealth has provided in the past, like sick leave, some old supplemental cost of living adjustments that were provided that go back to 2008, that's the last one, but because they're being paid on a 20-year amortized basis, we still have amortized payments being made on these benefit adjustments because that's what these reflects. It reflects that certain benefits were paid not lump sum, like sick leave or those old COLAs, but they were paid on an amortized basis, and eventually those amortized bases became over a 20-year period. So you do see it decreasing because we're starting to pay off some of those old additional supplemental cost of living adjustments. And you will continue to see that, and eventually all those old COLAs will be gone. And the only thing reflected on this line will be the amortized cost of sick leave. Immediately below that is what we would ask for sick leave if we didn't want to amortize it but just pay it in full. So you'll see $39.3 million for fiscal year 23 and $39.3 million for fiscal year 24. And obviously the decision whether or not to pay that in lump sum as opposed to the old amortization or to continue the amortization is a policy decision for the Commonwealth. The next line is the additional employer contribution required, $629.4 million in 23, $646.5 million in 24. And again, this is the additional funding that we need to implement the funding plan to pay off that legacy unfunded liability. And we have about 22.9 years left in that amortization period as of the end of this most recent fiscal year. And again, when that legacy unfunded liability is paid off, it's going to be a great day because then the cost of the Commonwealth for TRS will be a little bit less than Social Security. In fact, we're getting more than we need, just to put aside to pay benefits for teachers as they every year, with just the fixed contribution. So the fixed contribution amount can even go down after we get to 100% funded. So that box below that, okay, let me just go straight down to the TRS budget actual requested, the description on the left, and that box, that is going to be $843.2 million for fiscal year 23, $852.6 million for fiscal year 24. And that represents the total budget request that you would see in the TRS budget request. It does not represent all the dollars that would go to TRS, though, okay? Because we have to go to the next line, because in addition to the TRS budget request, there is a KDE budget request in the SEEK formula, and that represents the on-behalf payments that the Commonwealth makes on behalf of districts for retirement contribution, employer retirement contributions to TRS. And it goes for the SEEK budget. And we work with the KDE on trying to project what payroll is going to be and what these requests might look like. But ultimately, that's a KDE budget request. And you'll see the SEEK ask is $438.7 million in fiscal year 23 and $448.5 million in fiscal year 24. And the box below that represents, the boxes below those two numbers represent all the dollars that are going to go directly to TRS or requested for TRS for the next two fiscal years in the upcoming biennium. And that's the $1.289 billion for fiscal year 23, $1.301 billion for fiscal year 24. And we always add the very bottom line just to, because this is in our budget, it's just reflected in our budget. And you'll see state's expenditure for debt service, okay? So what that reflects when shared responsibility came about and some contributions have been reallocated from pension to medical insurance, to pay those costs. The Commonwealth issued a $467 million bond in August of 2010 to repay, if you will, in full the TR's pension fund for those contributions that have been reallocated to the health insurance trust. And then additionally, they issued a bond of $269 million in 2011 and $152 million in 2013 for transitional funding for health insurance costs, because active teachers in school districts didn't start paying that additional 3% in 2010 all at once. They phased in from July 1st, 2010 to July 1st, 2015, okay? So the state issued 3 bonds, and this represents the debt service on those bonds. Those were 10-year bonds. So you see that we're down to $17.4 million we don't receive. The TRS does not receive that money. It goes to the people who bought those bonds, but that $17.4 million will be paid in 23, and then those bonds are completely paid off in 24.
Let me stop you, Bo, and Co-Chair Higdon would have a question for you. Go ahead.
Thank you, Mr. Chairman. I guess we need to have some sort of celebration with those shared responsibility bonds being paid off. That's good news.
Yes,
Very
sir.
good news.
Yes, sir.
A couple of questions, Mr. Chairman, if you don't mind. I know the hour's late, but on the state's portion of shared responsibility, $71 million and $77 million up there at the top, and that's up from $61 million and 21.
I'm going to need to stop you. This is my question.
Okay.
No, you go ahead. No, you go ahead.
I can skip down. I got plenty.
You're
I got
right
plenty
on track.
questions.
You are right on track.
Can to help us understand, can you share us the formula or the math on that when at some point?
Yes, I'd be glad to. Some of these numbers, like for the 21 number, okay, the budget requests are based on, a fiscal year that hasn't happened yet. So we have to project how many people are going to be on health insurance, how many, premiums are we going to be paid? What are those costs of premiums going to be for the KEHP? What's going to be the cost of the premiums for the medical, eligible health plan, for the 65 and over group. So we were projecting that, and there's always an over-under. So for fiscal year 21, that $61.7 million, that would represent a reduction because we got more than we needed in fiscal year 20. So now we would give the state an offset for 21, and we do that with each budget. So health insurance is more likely, again, hopefully medical inflation stays the same, and those federal subsidies are still there. Health insurance would be more along the line in the $70 million range going forward, as you see for requested for fiscal year 23 and 24.
Okay. And the, Mr. Chairman, if you don't mind, the amortized payments that are steadily decreasing, what's included in those?
The only thing that is left for 23 and 24 now is health insurance and those old additional cost of living adjustments. There's a fixed statutory COLA of 1.5% for retired teachers. And back when, budgets were a little bit better, back in the day, TRS would occasionally request additional funding, to provide something above the 1.5%. Back when inflation was a little higher, to keep pace with inflation. And additional funding was provided some years. If it wasn't provided, the additional COLA was not provided. We'd never provide a COLA without the additional funding to pay for it. But some additional funding was provided. The last year that happened was 2008. But because these are 20-year amortized periods, there's still some payments left on those COLAs. But every year, a COLA payment for that supplemental COLA rolls off. So it decreases just because of the COLAs rolling off.
Is also included in that amortized payments the sick days?
And the sick leave, yes.
Sick leave.
And the sick leave is the one thing that would remain if we don't just start paying the full cost of sick leave, which is represented by the $39.3 million.
That's great to see that number, and I would certainly, that'd be my recommendation that we pay that yearly going forward so we're not accumulating it. That we're paying for those over 20 years. One other, comment and back in 2016 when we paid the full ARC, it was $500 million in each year, and looks like now we're the ARC is looks like for 24 is $770 million a year. Quite a bit of increase in 6 years. Do you anticipate that to continue to increase every year from now on like it has over the past 6 years?
Now, that $770 million is going to reflect the green box dollars and the sick leave.
Okay.
And the sick leave, and that's going up somewhat because, that $39.3 million reflects paying the full cost rather than just an amortized portion of the sick leave.
But the $646 million would be the
yes, sir.
Would compare. So it's still, and looking at that, it's gone up, I guess, in the 6 years, $146 million a year.
Yes.
And do you anticipate those type increases going forward for the next 20 years?
So with those changes and assumptions, the assumed rate of return and mortality tables, we recognize those immediately, but we're phasing in the increased contributions over 5 years. So you will see increases more like this over the next 5 years, and at that point they will level off a little bit more because we won't be building in budget requests based on those assumption changes. They'll be done. And at that point, the increase will largely just be a factor of payroll growth. That's what we'll be requesting. I mean, there'll be changes with, experience studies and, the annual evaluations, but they'll be more modest. You'll see something closer to payroll growth. And of course, we, part of the assumption changes lowered payroll growth from 3.5% to 2.75%. So when you do that, you flatten those increased future budget requests somewhat because you move away from level percentage of payroll funding. And you're still doing that level percentage of payroll funding, but you move closer to something like level dollar, where payroll growth doesn't matter and payroll, budget requests don't increase with payroll growth. So, long story short, you're going to see increases for 5 years, more like this, and then after 5 years, you'll see increases that are more along payroll growth at 2.75%.
Okay, thank you, Mr. Chairman.
Thank you. Are there any other questions? Well, I think we're going to let you go.
Okay.
Maybe we'll let you switch the order next time and get you go first. Okay.
Thank you, Mr.
Thank
Chair.
you for your testimony, and you are free to go if we don't have any more questions. Representative Miller would like to discuss a couple pre-filed bills that he has for us.
In Thank you, Mr. Chairman. And in each case, hope that these are included in the PPOB's year-end recommendation to the full body in terms of bills that they would support. The one coming right behind the actuarial discussions that we've just had, House Bill or BR 40 or 341 rather would take this assumption changes, these valuation changes that right now is on a 5-year cycle, and as we've just heard, it's a big number every 5 years, or potentially it's a big number every 5 years, and it would separate out the demographic changes, which is where the lot of the actuarial work is, and is very time-consuming. You'd still do that every 5 years, but the economic assumptions like payroll growth, return assumptions, you would do that every 2 years, consistent with the biennium, so that we're not every 5 years getting whipsawed, and which, again, as you've just heard, has a pretty good impact on those valuations or the amount we're asked to pay in terms of employer contributions. Mr. Chairman, I'll ask if there's any questions. Otherwise, I'll go on to the other one.
Seeing none.
Okay, and the last one is BR 40. Now, this is something that the PPOB probably would not take a position on, but it is a bill that cures an issue. Several years ago, as you, for those of you that have been here a while, know we put in some spiking measures, prevent spiking, and they had several exceptions that where you wouldn't have that penalty that's discussed in KRS 61598, for example, which is in one of the plans. Each of the plans has a spiking provision. One of the exceptions is state of emergency. If the head of the local government declares an emergency and say your police have to work a lot of mandatory overtime, which they have no choice over where they have to work it or not, that it would take that into consideration. Well, what happened in Metro Louisville last year after the unrest related to George Floyd and the tragic killing of Breonna Taylor, LMPD was working massive amounts of overtime, and because the mayor did a state of emergency, but the governor did not do a state of emergency, it did not trigger this spiking exception. But if you recall, the governor actually sent in the National Guard. So obviously it was a big deal. And so this changes the law to say that if a local CEO of a government declares a state of emergency and the governor either has declares it a state emergency or sends in the National Guard, then this spiking provision would not hurt these people that have no choice in whether they're going to work this overtime. So I would just ask you to look at that. And again, I don't think this is anything the PPOB would want to opine on in December, but it is something that's very important and would ask your consideration of it and questions if you have any.
Thank you, Representative Miller. I do think it has a lot of merit. And Representative Tipton.
Thank you, Mr. Chairman. Representative Miller, would this be retroactive to the events of last summer?
And it would be retroactive to May 30th, which is when the governor sent in the National Guard. It followed, thank you for bringing that up, Representative, and it would make it retroactive to that because there's a lot of people have been retired that have retired in the last 14 months that got hurt in their retirement because of this provision. So, thank you.
So just to be clear, for a mayor to be able to do this, the governor would have had to call in the National Guard. If he calls in the National Guard, then for that particular police department, they would not be hit with a spiking.
Correct. And as it is today, the governor has to declare a state of emergency. Well, he skipped that and just sent in the National Guard. So.
Yeah, but my question is does the National Guard have to be called in? In other words, if the governor doesn't call the state of emergency, but a mayor feels that it is one, this still doesn't.
It still doesn't do that.
It does not trigger the spiking.
It does not trigger the spiking.
Okay. Thank you. Sir, Representative Graham. Use your mic, please.
For those who retired, this would correct that.
Yes.
Who have been retired. So
yes,
correct.
Sir.
Okay.
Yes, Representative, it would correct that.
Thank you.
Representative Wheatley.
Yes, and I also support it, but just for further clarification. So if the governor calls, if there's an emergency exists and it causes overtime for any employees, and there's a spiking provision, an anti-spiking provision that would kick into effect, but this would prevent it because in this an exception. That still all exists for all the other employees. This is a particular one that could arise if the mayor calls one. And
well, no, I don't believe that the mayor can call a state of emergency. Therefore, this would not impact.
Right. You would have to have both.
You have to have the governor call the state of emergency.
Either call a state of emergency or send in the National Guard.
Okay, and there is an or after section, or after, section 1 there of that subsection.
Yeah, the mayor calls.
So that would sound like the mayor could do it.
Only if the governor has already taken measures of a state of emergency or sent in the National Guard.
Okay. Just want to clarify that. And
well, I welcome all suggestions to clarify before session.
Any other questions for Representative Miller? I want to thank our presenters today. You did a great job, a lot of information to digest, and we shall continue to do so. I want everybody to have a wonderful Thanksgiving.
Thank you.
And we will see you